Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on everything that you need to know at 3 p.m. Eastern Time. Disney CEO Bob Iger, he isn't wasting any time slashing $5.5 billion in costs and reorganizing the company into 3 divisions. We will be breaking down what that looks like and why Wall Street is so bullish on the stock.
Plus, the battle over pricing. Fast food is winning so far in the fourth quarter as inflation keeps customers away from higher-end restaurants. The Pepsi CFO telling us that the company has no plans on cutting back pricing at any time soon. We've got the details for you.
And the hawks are circling. A week of comments from Fed officials giving investors more than a little food for thought. Should we look past it or take them at their word? We put it all into perspective. But let's begin today with the markets. We got an hour to go in the trading day. We're not too far from the flat line with all 3 major averages. The Nasdaq, the underperformer of the day, off just about 0.7%. Taking a look at the sector action, most of the sectors trading to the downside today. Consumer discretionary, the outperformer here, up just about 0.4%, but the losses really being led by communication services and also materials.
Really, the big story of the day remains Disney, and that was quick. Activist investor Nelson Peltz ending his month-long proxy battle with Disney after the company announced a slew of restructuring plans. Peltz's Tran Fund Management telling Yahoo Finance, quote, "The proxy fight is over." This is a win for all shareholders. Let's catch you up to speed on all things Disney with Yahoo Finance's Ali Canal and Josh Schaefer. Ali, let's start with Nelson Peltz. This reminds me of the other day. I said to my son, I claimed a victory about a win that I thought would happen. He said, "Dad, I don't care. You didn't put any money on it."
Yeah.
Did Nelson Peltz do anything here? Or is he taking a victory lap for things that were already in motion?
Well, he thinks he did. He thinks he essentially got everything he wanted, but really what he wanted was a seat on the board, and that's just not happening. And it feels like this was very anticlimactic considering all the drama surrounding this company and this proxy fight over the past few weeks. But they did want those operational efficiencies. They did want cost cuts. They wanted the dividend returned, and they wanted a post-Iger succession plan. And they essentially got all of that. As you mentioned, the company announcing it's targeting a reduction in costs of $5.5 billion, laying off 7,000 workers as a result. Iger did confirm that he asked the board to reinstate the company's dividend by the end of the calendar year. That was halted during the pandemic in an effort to conserve cash, and it will be modest at first, but steadily increase over time, with Iger saying that this is all possible because of those cost-cutting initiatives. Now, along with those cost cuts and operational efficiencies, Disney will restructure the company into 3 different divisions. That means for the first time, we're going to have ESPN as a standalone service, so we will get those standalone numbers for revenue and earnings. In addition to ESPN, we will also have Disney Parks and Consumer Products, along with Disney Entertainment, which will include streaming as a whole. So I think it's interesting that we're going to sort of see the nitty-gritty look under the hood with ESPN, especially since there's a lot going on at this company, Disney holding firm, that does not want to spin off ESPN at this point, but this could be a hint that eventually we could see an over-the-top streaming service.
Yeah, and I think a lot of people initially, when they heard that announcement from Iger before we got his comments that he doesn't intend to spin it off, the initial thought was, hey, maybe Disney is setting ESPN up for an eventual spinoff. But Josh, taking Iger's comments following that into account, what is the street saying today?
Yeah, I mean, it's interesting because there are still some people talking spinoff, right? Or at least 10 to 15%. That was what Laura Martin suggested. Maybe ESPN would go for that. But I do want to also sort of add to the fact here, I think it's interesting to think about what we're going to get to see from ESPN and what the product really is here, right? We're going to finally, as Ali said, get to see those numbers and how much they're spending versus how much the revenue actually is. You're looking at $2.7 billion a year on Monday Night Football, and that's $165 million on just the talent alone and two of those hosts, right, Dave? I can see Dave already starting to smile. And you think about sort of what the product is, and you look at the ESPN Plus total subscribers right there, almost topping off over the last 2 quarters, really not coming up much, guys. Mm-hmm. And that's a $9.99 a month product that we're talking about with ESPN Plus. And Dave, you're a big sports guy. Let's read just some of the things you get with ESPN Plus. The PGA Tour, NHL, some college basketball, and UFC. That's probably not moving the needle for more than $10 for you, right? So you're going to need to buy something.
Not spectacular.
You're going to need to buy something else. And that's what Bob Iger talked about last night with those NBA media rights.
It ain't cheap.
Over $7 billion it's been estimated at when that NBA deal comes up in 24 or 25, guys. So that's going to be interesting to see how ESPN spends there. And does it go to the plus or does it go linear?
When you're cutting costs on content, it's tough to justify that kind of spend.
It is.
Remarkable.
Yeah, it is very, very tough.
Do you know, this is National Cut the Cord Day.
Is it really?
Yes, it
That's
is.
National Pizza Day, National Cut the Cord Day. Wow, we're covering all bases here.
You're welcome, people.
Alec and Al, Josh Schaefer, thanks so much. We want to stick here with the discussion of Disney because taking a look at where the stock is right now, it is trading to the downside actually now, off just about 0.4%. Wall Street seeing Iger's revival here. The plan, a reason to buy the stock maybe here in the future. At least it doesn't look like that today. Well, here to weigh in, we want to bring in Jessica Reif-Ehrlich, a Bank of America Securities senior U.S. media and entertainment analyst. Jessica, it's great to have you here. I was on the call. It certainly was an entertaining call, one that was full of headlines. What was your just initial takeaway from what we heard from Iger yesterday and what that means for Disney going forward?
It was pretty much as expected. Bob Iger is very decisive. He's strategic. And his history, when he took over from Michael Eisner, just tells you that, it told us that he would act very quickly. And that's what he did. He, as you guys just said, he announced significant cost cutting, a reorg of the company, the dividend, no ESPN spinoff, and definitely not a sale because their tax basis is so low. Hulu is a question mark, but he kind of, went through everything. And I just feel like in general, there's he exudes confidence. He's had a remarkable career, and I don't think he's going to want to end this one in a poor way. So having him there for at least 2 years, it should be a very positive thing for Disney shareholders.
Yeah, he's kind of the George Clooney of CEOs. You say exudes confidence. He's so regal, if you will, but he's only got 2 years, to your point, and now 21 or so months. Let's get back to Hulu. He says everything's on the table when it comes to Hulu. What do you expect him to do there? Buy out the remaining portion that Comcast owns, or the opposite, get rid of it?
Well, two things. One, he said at least 2 years, so we'll see how long he really stays, because there's a lot to do in that 2-year period. As far as Hulu, there's a put call with Comcast in early 24. So there's really no choice here about the short-term action with Hulu. Our view is that Comcast is not a buyer, which means that Disney has to buy them out of the 1/3 that Comcast owns, so $9 billion or so. And that's early 24. Once that happens, unless they find a third party, but once that happens, the question is, what do they do with Hulu longer term? And he did say everything's on the table. And he also said that general entertainment is not really very, distinguishable from there's so much of it available. So, if they choose to go the route of selling Hulu, what does that mean? Is it Hulu the service? Is like what content goes along with it? Does it include FX? Does it include the Fox movies? So it's just it really, we don't really, it's not defined as to what would go with Hulu.
And Jessica, there's also lots of talk about pricing today. When it comes to Disney Plus, certainly we did see a drop in subscribers there for Disney Plus last quarter. But how much pricing leverage do you think Disney has when it comes to Disney Plus?
Well, they just raised prices December 8th by 38%. I mean, that's a big increase at one time. And the churn was minimal, which is really good news. So our expectation is they'll roll price increases out globally or in most markets, along with the AVOD or the advertising tier. They just started advertising in the U.S. So there is definitely pricing power. I think one of the things that people aren't really talking about right now is what a needle mover could be. And their advertising tier, again, introduced the day they increased prices, December 8th, could be a really big driver over the next 3 years or so, because Disney Plus has premium video content with, they're offering advertising. It's really a relatively limited amount of inventory. Eventually, it'll be addressable and targeted. And so it's really attractive advertising inventory for advertisers. It's a way to really, it's a good quality environment for brands. So our expectation is that this is going to be one big revenue driver. Another one that was discussed on the call last night was content monetization. I don't think they were as clear on that, but they said they would go back to traditional methods. But what we believe that means is that they will they kind of pull back selling content to third parties. And that's billions of dollars that they've kind of foregone. And with that, kind of the door opening up to that, with windowing, it could be a very significant revenue driver. I mean, the goal here is really to drive profits.
If you were drinking every time Bob said creativity, you did not survive the call. I've always believed that the best way to spur great creativity is to make sure the people who are managing the creative process feel empowered. But in terms of the content, he mentioned more sequels for Frozen, Toy Story, and Avatar. And don't get me wrong, those are great franchises. But what's the sticky content when it comes to streaming? It seems that every title that is really a hit these days comes from Netflix.
Well, Netflix has phenomenal content. Absolutely. It took them a long time to get there, but it's been hit after hit. But for Disney, they have branded content. So, you know what the Disney brand means. It's family friendly. Pixar animated. Marvel is, superheroes. And then Star Wars, or Lucas is Star Wars. So you kind of know what it is. And they've done a really good job in creating a lot of the Marvel content. They've created new characters and new storylines. So they have a lot to work with. But the franchise is what drives them. I don't know that they're just only going to do franchises, but they have a lot of content, maybe too much content. And that's part of what they were saying last night. That of the $5.5 billion of cost cuts, $3 billion will come from content over a number of years.
Yeah, really interesting headline number there. Jessica Reif-Ehrlich, nice to see you. Thanks so much. Good insights there. Let's get up to speed now on the state of the consumer as far as companies like Pepsi, Unilever, and Kellogg are concerned. Consumers in the U.S. are doing just fine as businesses raise prices to combat high commodity costs. The average shopper is eating those price hikes literally. Pepsi's CFO Hugh Johnston saying on Yahoo Finance this morning that the giant has zero intentions in cutting prices, despite the fact that Johnston thinks we could see a recession later this year. Listen.
We have no intention of cutting prices. That's certainly not part of the year. Frankly, we're coming out of 2022, which was just an outstanding year. I mean, 14% revenue growth, strong EPS. Obviously, the company is just firing on all cylinders, competing very effectively. We've got good momentum coming into the year, but we're also well aware of the fact that, in a high interest rate environment, it could start to drag on consumer spending at some point.
But it's not. And really, when you look at the theme that emerged, we kind of just hinted to it, alluded to it, Shauna. You've got these big companies, Unilever, Pepsi, and Kellogg, and really one theme emerged. Volume was down, demand was slightly down, but price hikes made up for it. And they have no intention of lowering those prices.
Yeah, but you got to ask how long that can continue for, because even where we are today is a little bit different than where we are in the fourth quarter of last year. And I think we're starting to see consumers continue to pull back on spending. You don't have to look any further than the recent retail sales reports to show you that. So yes, they do have the power, but I think it's also going to be a very brand specific story, right? Pepsi, maybe they do have the ability to raise prices even higher from here. They're saying they're not going to, but maybe they would. But it probably wouldn't really hurt margins too much. Unilever saying that they likely will raise prices in the future. And remember that this is coming after the company has raised prices for the 8th consecutive acceleration in prices that we have seen in the quarter for Unilever. They are up about 13% right now. And they're saying that prices could be headed even higher because they've only passed on about 3/4 of the higher cost to their consumer. And then comparing the demand there to what we saw from Chipotle, where Chipotle doesn't really have any room to raise prices any higher because of that falling demand. So I think some brands still have that pricing power. They're going to have the ability to raise prices even higher in this current quarter, maybe into the second half of the year, to continue to offset inflation in their business. But I don't think that's true across the board. Yeah,
Chipotle's a great point because visits were down 10% in the quarter, and they saw the drop off among those that make $75,000 or less per year. They found that they clearly hit the ceiling in terms of how they can raise their prices. But again, they're not lowering those prices and didn't mention any plans to do so. And to your point, wow, that Unilever number with 13%, but that cut volume by 3.6% worldwide. I can't help but wonder what's the Fed story here. How's our boy JP, Jerome Powell, seeing all this? Because there's no deflationary story here. No. They're going to keep these prices high, and I can't help but wonder if he sees these numbers and say, whoa, we got a lot more to do before we can get anywhere near that target of 2, let alone something closer to 4.
Yeah, certainly. I think there clearly is a lot more work to be done. That's kind of what we heard from a number of Fed officials even this week, in addition to Powell. A number of Fed officials coming out saying that higher rates are likely, that they probably will be necessary given that environment right now, higher prices, and then not even to mention that jobs report number that we got last week.
Massive 517 spot, yeah.
Crazy. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, our next guest believes that corporate America is in for a slowdown and not a recession. She'll tell us why. And 3-time NFL Defensive Player of the Year, J.J. Watt, is here to talk Super Bowl 57. And earnings from Lyft and PayPal are on tap after the bell. We will bring you those numbers as soon as they break. Don't go anywhere.
All right, a quick check on the markets now. Stocks are trading down near session lows at the moment. You can see leading the way down is the Dow, 0.7%. Nope, the Nasdaq almost down 1% on the day. Pretty slow day, but a lot of red on that board. Big stories we mentioned here. Pepsi rising on a beat at the top and the bottom line. Disney up a bit, sinking now, while Mattel, rough go, plunging as consumers really pull back on spending. Meanwhile, in the labor market, we're seeing an uptick in jobless claims from the previous week. The number of Americans applying for unemployment benefits rising by 13,000, in stark contrast to that Friday jobs number. For more on this, we turn to Callie Cox, eToro USA investment analyst. Nice to see you. So let's just start, big picture and how you would characterize the economy at the moment. Jamie Dimon with Reuters said it's really strong right now. And what's been your prevailing lesson through earnings thus far?
Well, I certainly wouldn't take Jamie Dimon's side because he did say it was like a hurricane a few months ago. But In a way, I do agree with him. I think the economy is proving more resilient than we think. And there are a lot of signs around us that point to that. I mean, the jobs number that we saw on Friday and the earnings season, where earnings once again are coming in better than feared. That's not to say that we're not in this slowdown of sorts. I think it's clear that we are, but we're not quite in that recessionary period just yet, even though there could be some mini recessions rolling through the economy.
Well, Callie, a big question mark in all this is the consumer, the strength of the consumer right now. We're starting to see some of that spending cool a bit. How worrisome is that for you?
So I won't be too worried about the consumer until I see the job market crumble, because the job market is the engine of the economy, and it's the primary reason why Americans feel so good about spending right now. I think you are seeing spending slow down in certain sectors for sure. We have seen that goods to services rotation, and now we're seeing, services bring in some iffy activity numbers. But overall, the consumer still looks quite strong, especially considering the hammer that the Fed has taken to the job market and the bluff that the job market has pushed back on that.
Yeah, and how do you think the Fed, and though Jerome Powell was asked about this multiple times the other day, how do you think the Fed actually did see that Friday jobs report and these couple of earnings that we've seen the last few days where the consumer is continuing to spend?
Well, the Fed is in a tricky place right now, and I want to be clear: a strong job market is a good scenario. It's kind of tricky in the context of an unbalanced economy, but it is a good thing that people have jobs and they're making a living wage, and those wages are growing. The Fed sees it as tricky because the Fed is trying to get demand side inflation down, that's services inflation, and that's more driven by the job market. It's more driven by the fact that we're making a higher paycheck. So the Fed probably, after those job numbers, probably sees more of an argument to keep rates higher for longer. We already knew that was happening, but the market is realizing even more so that the Fed has a case to do it.
So, Kelly, in that environment, so far to the start of the year, we certainly have seen a rally. The Nasdaq's up about 12% since January 1st. Can this rally continue given this high rate environment?
Yeah, so I suspect that we've seen this growth-fueled rally because we've seen such a precipitous drop in long-term yields, which could be a bad story. Typically, people pile into bonds when they're worried about growth. But on the short side of things, short-term rates really haven't budged, and the Fed has given us no inclination that it expects to cut rates anytime soon. So we're getting a little cautious around where this rally is now, especially because it's been fueled by these growth and speculative stocks. We're reminding customers that it is a high-rate environment, and because it's a high-rate environment, people are going to be looking toward what's working now versus what could work later. Just to proceed with caution here because the air is thin.
And Callie, zeroing in here on inflation, that rate that we're seeing today, lots of talk about getting it back to 5%, that's not too far from where it is today, but then getting it all the way back to that 2% level that the Fed wants. Is that realistic?
That's going to be tricky in our view because, again, they're looking at demand side inflation. They're looking at the services inflation, the kind of inflation that's fueled by a strong job market and wages. And again, it's good that we have a strong job market, but it makes the Fed's job a little bit harder because the Fed needs to get that demand down a little bit more. Thankfully, it's moving in the right direction now, which keeps us optimistic. But there is a bit of a worry that services inflation could stop at an elevated level, and that could keep inflation around 3, 4, 5%. Historically low, but also quite higher than where the Fed wants it to be.
And you say you're talking to clients about what's working now and against what's going to work later. Given the setup you just laid out, what do you see working later?
So when I say working later, I'm talking about companies that are relying on either concepts or companies that are being invested in because people are optimistic they can earn profits down the road. And talk about the inverse of it too, what's working now. We're thinking about financial strength. We're thinking about quality. Those companies that are generating cash flows and are generating profits in an environment like this. And it's not wrong to invest in more speculative stocks, but we're just being careful about reminding people that, in an environment like this, those smaller, more speculative companies struggle to get that investment, struggle to pick up that capital. So it could be a more riskier endeavor than you think.
Indeed, a tough environment for capital. Callie Cox, eToro USA. Nice to see you. Thanks. Coming up, MGM shares rising despite reporting mixed Q4 earnings. Part of the reason might be because of what's happening in March. What is that? We'll tell you next.
Time for Triple Play. Josh Schaefer is here to talk to us about 3 stocks that we're watching in the final 30 minutes of trading. We have Affirm, MGM, and Canopy Growth. Kicking off with Affirm, it's a top trender today on Yahoo Finance. Shares selling off. Look at that drop, off just about 18.5%, off the lows actually of the day. Now this drop coming after the company's earnings and revenue both missed the street's expectations. The company also announced plans to cut 19% of its workforce, which is expected to generate savings of about $80 million. Now, despite these cost-cutting efforts, RBC downgraded the stock today, writing in a note to clients that the firm is, quote, stepping aside until we get a clearer picture. Now, they cited higher funding costs and a deceleration in consumer spending as challenges that are clearly facing this company. And Josh, this note and this drop today comes after what was an extremely rough 2022 for Affirm and many of its peers in that sector. We'll hear from PayPal after the close today, but clearly when consumers pull back on spending, it's not good news for these names.
And you remember to start 2022, Buy Now, Pay Later was one of the hottest investing stocks articles you could read online, right? That was everyone's great idea for 2022 almost, it seemed like, and it just didn't go well for Affirm because we were talking about consumer spending. I mean, you take a look at Affirm's order volume quarter over quarter, how much people are paying per order. It was up around $550 at one point, now down all the way to $300. People are spending less per order, meaning they're kind of cutting back spending, right? They're literally just not buying as much product per volume there, Dave. And the other thing I think that's going to be interesting too, when we talk about PayPal, they have Venmo. Apple might get into the space. It's kind of a buy now, pay later, sort of an afterthought for them. This is Affirm's core product. They need people to spend money. And I don't know if people are going to spend money at the rate that they need them to this year.
Yeah, Venmo keeping afloat,
right.
PayPal. But we talked to Dan Dolet from Mizuho yesterday. I asked him, is it a sector problem or an Affirm problem? And he said, truthfully, Affirm is best in class when it comes to buy now, pay later. That tells you a lot about this class, one you do not want to enroll in.
It's an ugly class
ugly
to be in
ahead.
right now.
Yeah, get out.
A class I would enroll in though, Dave. Maybe.
There we go. Nice transition.
We'll spin the roulette table, all right? We're going to talk gambling.
We're both in.
We'll take a look at shares of MGM. They're in the green today after an upbeat earnings report with sales of $3.59 billion, besting Wall Street estimates, and the company casting a positive light on the return of not only Las Vegas gambling, but also Macau and China. So CEO Bill Hornbuckle saying in today's earnings call, March is positioned to be the best hotel revenue month in company history. That's in large part due to the big dance. March Madness, Sweet 16, and the Elite 8 are going to be in Vegas this year. And last note here, Dave, I want to point out, I want to look at Wynn too. Investors appear to be happy with what both Wynn and MGM had to say about their operations in Macau. MGM says quarter to date, that's their highest earning part of their business. And then Wynn adding the company has, quote, great confidence that the difficulties are behind us, again, specifically in Macau. Maybe we're finally turning a corner there. I feel like we've been talking about this for months, guys, and it's one day's positive, the next day's negative, so who knows what comes.
Yeah, it sure looks like the worst is behind them. Hornbuckle said, simply stated, Macau is back. And when it comes to Vegas, it's astonishing, man. I was there recently. Everything in sight was packed. And Hornbuckle also said on the call that the LVCVA says flights to Vegas are at 120% of capacity from 2019 levels.
Wow.
120% from prior to the pandemic. Vegas is not just back. It's bigger than ever before.
It sounds like it's booming. If I'm planning a vacation, because I haven't gone on one since the start of COVID, I'm personally not going to Las Vegas. So I'm a little surprised that those numbers are so high. But when you talk about that type of demand, these companies are able to charge much more for their daily rates. MGM's daily rate up 30%. That's a massive jump that we're seeing.
Highest revenue
there.
ever.
Yeah.
Ever. I mean, that's
Pretty
And
impressive.
Josh are going. They're not worried.
I would go.
are
I'm
going for the
just
Sweet
not
16.
dying to go.
We'll talk to you
I wanna go
live
for
from
the
the
Super
Sweet
Bowl next
16.
week.
West
Okay.
Regional, we'll be live there, okay? My play is Canadian cannabis company Canopy Growth continuing to slash jobs today, announcing what CEO David Klein called, quote, difficult but necessary cuts of around 800 jobs, or more than 40% of its total workforce, as it works toward a, quote, asset-light model. Their CFO, Judy Hong, saying the right sizing of our Canadian business is expected to significantly reduce our cash costs. The cannabis company said its third quarter revenue fell 28% year over year. The U.S. listed Canopy shares falling today 17%. It is just ugly, more than 70% over the last 12 months. The industry as a whole is really plagued by a laundry list of issues. That includes the lack of optimism for any U.S. legislation that includes legalizing or even allowing access to traditional banking or safe Earlier this week, California-based MedMen, what many felt was the Apple store of cannabis stores, warned investors it may not have enough money to meet its obligations. Curaleaf, Tilray, the cannabis ETF MJ, all falling big on this news. I hate to say it, but it is really desperate times in that industry. I hope Washington is listening and maybe there is some action, but don't hold your breath.
Yeah, it certainly is very desperate times. And even just to put that even more into perspective, Canopy Growth was a company with a market value at one point at about $20 billion. Today, it's just over $1 billion. So you really just illustrates the massive downfall that we have seen not only in Canopy, but really in the sector at large. And you're talking about a company, this is the second restructuring that we have heard from them in the past year. So tough times. The stock off pretty significantly today. All right, well, coming up, a strike may have been avoided, but the White House renewing its pressure on railroad companies to get something done about sick leave for its rail workers. We've got the latest when we come back.
Pressure is heating up again to secure an agreement for paid sick leave between rail workers and their operators. The latest development since President Biden signed legislation to block a national rail strike in December. Let's bring in Yahoo Finance's Danny Romero with the latest. Danny, what are we learning?
Yeah, so there's a big picture going on right here. So it is the fact that workers still have the upper hand. And on Wednesday, we learned that two unions reached a voluntary agreement with CSX Transportation. And it really shines a light that the fact that these union workers, like I said, still have the upper hand. And I want to make it clear that this voluntary agreement was on behalf of CSX Transportation, not the union side. And so the deal includes 4 paid sick days and 3 paid personal days per year. It also impacts about 5,000 union workers. But if we backtrack just a little bit, like you said, President Biden signed legislation last year to avert any form of a rail strike. So the fact that this current agreement really was on the table and it was a voluntary agreement on the railroad operator side really does move the dial a little bit for these unions. And so from industry experts I've spoken to, it also gives it a little bit more pressure, possibly, that other railroad operators will join in and jump on the same bandwagon and offer these incentives to these rail unions. And so far, Union Pacific, BNSF, and Norfolk Southern do not currently offer workers any paid sick leave. But that doesn't mean that later on, like I said, that they would offer these worker benefits. But it also does possibly signal that CSX Transportation is really trying to find more workers. And so they're trying to incentivize, and this could be some way of doing that.
Certainly sounds like a step in the right direction. Danny, this week we also heard from President Biden during his State of the Union address that his administration is once again advocating for family leave. When you talk about the progress here on the rail worker talks, does that help that narrative that the Biden administration is now pushing when it comes to family leave?
Yeah, Shauna, you do bring up a really good point, right? This narrative really does add to the Biden administration's narrative of being pro-union. It also gives the administration a leg up. And so if we go back to the State of the Union address, Biden advocated for more worker benefits and specifically around family leave, but he did not propose any legislation in the future or any current legislation for that matter that would really tackle worker benefits. So if there is going to be a change, it probably would come from the state and local level. But again, this really is a progress for the union side and also for the railroad operators themselves.
It certainly is progress here. All right, Danny Romero, thanks so much. Well, coming up, how do you grow a media network in a time of increased competition and slowing ad sales? The CEO of hip-hop network Revolt will join us next. But first, we've been talking about Disney this week. Now, here's what you need to know about the company.
Disney cutting 7,000 jobs in an effort to slash $5.5 billion worth of costs. The news comes as the company beat earnings expectations on both the top and bottom lines for its first quarter. Here's what you need to know. Disney reporting its quarterly earnings results, beating analyst expectations on both the top and bottom line. The House of Mouse posting earnings of 99 cents per share and $23.5 billion in revenue for the first quarter of 2023. This is the first earnings report since Bob Iger made his surprise return as Disney CEO back in November. Iger sharing the company's plans to cut costs, which include reducing the workforce by 7,000 jobs. He told shareholders he does not make this decision lightly and that the changes will put Disney in a better position to weather future disruption. The Disney chief executive reassuring investors the new strategic organization will result in a more cost-effective, coordinated, and streamlined approach to running the business. Disney also reported an expected dip in subscribers on its streaming platform Disney+, but an improving loss overall in its direct-to-consumer division. Another bright spot for Disney was its parks and experience business, which remains strong, growing a whopping 21% as Disney fans continue to flock to its theme parks in droves.
A slowdown in ad sales has led to layoffs across the media industry, with big companies like Alphabet, Spotify, and Amazon starting the year with cuts. Disney just yesterday announcing that it's laying off 7,000 workers, and employees at Comcast, NBC, and MSNBC are staging walkouts as a result of layoffs. So our next guest, though, running a media company that's seeing growth despite all of these macro headwinds. For that, we want to bring in Datavio Samuels, Revolt CEO. Datavio, it's great to have you on set. Thanks so much for joining us today.
Thank you for having me. Good to be here.
Well, we just laid out that it certainly is a very challenging environment for media companies right now. Your company, though, seems to be growing despite all of these headwinds. How so?
Yeah, I think you have a couple of things. One, you have the unfortunate murder of George Floyd. And once it happens, you have lots of advertisers that come out and make commitments, right? $350 billion committed to Black entrepreneurs, Black suppliers, Black media. And so what we have on our side is tailwinds. But when you look on top of that, what you have is Revolt, which is an incredible company. You're talking about the only Black-owned media company with a global icon on top like Sean Diddy Combs. We're one of the only video-first media properties that exist in the Black-owned media space, and we are in partnership with hip-hop. And so we always say, in the same way that hip-hop dominated the audio space, we believe that hip-hop is going to dominate the video space. And so we have built the #1 hip-hop platform in the world when it comes to the video space. We are the home to the biggest conversations in Black culture and hip-hop culture. And we've created this incredible, expansive ecosystem for Black creators who play in our world. And the last thing I'll give you is just an example. One of my favorite examples is we have a show called Carisha Please. And every time Carisha Please airs, she is top 5 trending on Twitter. She is top 5 trending on YouTube. She's #1 on Apple Podcasts in the music category, and then also top 5 in Apple Podcasts globally.
How essential is social media for you when it comes to not just traditional media, streaming media? Is social media the most important currency right now?
Well, social media is super important in a couple of ways. One, we know that Black folks over-index in their use of social media. So if you're going to create a Black-owned media company and you want to reach that audience, you got to be deep in there. So we're deep in everything from IG to Facebook to TikTok. But the other thing is that we know that it is an incredible way to not just promote your work, but to drive people to see the longer form content that you're creating. So social is an incredibly important piece of the pie for us.
When you talk about growth of Revolt, growth of your network, and one thing that you're doing, you're investing in your news division. You have plans to grow that. Where do you see the opportunity there at a time when so many peers out there, so many of the larger networks are actually scaling back some of that division? Yeah,
look, first we brought in an award-winning team to come do that. Monique Chenault, who's the head of Revolt Black News, is doing an incredible job. We just brought on a new journalist, our new anchor, global news anchor, Mara Campo, 4-time Emmy-winning news journalist. And where we see the opportunity is so much of the news was split into red and blue, and nobody was focused on Black. And so what are the issues that are important to Black people? As an example, in December, we just did an investigative journalism documentary on what we call the real thirst trap. And so we go into places, Mississippi, Compton, New Orleans, looking at air pollution, water pollution in these communities and the effect of Black and brown people. Those are stories that nobody is telling, and that's where we see the opportunity in the white space.
We started this discussion with you mentioning George Floyd. What about Tyre Nichols? What has that done for the niche that you are clearly taking advantage of and trying to create content for?
Yeah, so back to the importance of having a Black news division with a Black news perspective. I think what it allows us to do is tell the story from a very different perspective from what you're seeing in other places. Where I'll say that I'm disappointed is where you saw advertisers kind of come to the forefront with George Floyd, they've been much more quiet around Tyre Nichols. And again, I think that is a function of them seeing it as something that they're viewing as Black on Black, but that's not really what it is. The problem that we have in this country is with cop culture, right? And so if you take the history back into policing, there were these things called slave patrols. They were out there capturing slaves. There were absolutely Black people who were there helping to capture slaves. And so again, the issue is not about the 4 or 5 people who got it done. It's about cop culture in general and the systemic issues that exist in that world.
You guys are about to turn 10 years old.
Yeah.
Is there an enduring lesson that Sean Combs has taught you that's kind of how you've weathered, how you've survived, how you've grinded through this environment that Shauna mentioned on the introduction?
Yeah, Sean Combs is is just, look, that man is all about just being as disruptive as possible. And so that's the lesson. Never rest on your laurels. We have a show and we have a saying, no sleeping in the trophy room. So yes, we're up, 2 years, we've been killing it and crushing it, but we don't get to sleep in the trophy room. We got to keep going and going and going.
I like that. Bill Belichick, as soon as he wins the Super Bowl, he's on the plane thinking about
the next one. Exactly. Exactly.
Good to see you, man. Datavio Samuels, Revolt CEO. Great to have you here in studio.
Thank you for having me. Take care.
All right, coming up, the trailer for Ben Affleck and Matt Damon's new movie about the creation of Air Jordan brand is out. And boy, am I fired up about this one. Stick around. The movie industry is, quote, finished and will never come back. Those are the stark words from former Paramount CEO Barry Diller. I, for the most part, agreed with that grim sentiment this morning. Sure, we still have Marvel movies and the once every 20 or so years epic smash hit from James Cameron, but for the most part, what used to bring my family and yours to the movies is a distant memory. But then came a spark. A light I long thought burned out suddenly flipped on. Who'd have thought Amazon was responsible for turning that switch? The trailer for Matt Damon and Ben Affleck's upcoming Nike drama Air released. And with it, goosebumps. Watch.
There's nothing cool about Nike.
You would have to have a pretty compelling pitch.
I got it. I found him.
Who's that? Jesus? Can't afford it.
I'm willing to bet my career on one guy.
My name's Sonny Vaccaro. I'm with Nike.
Do you typically make it a habit of showing up at people's front doors unannounced?
I don't like to take no for an answer.
Oh, man. Here we go.
I need the greatest basketball shoe that's ever been made.
Who's the player?
Michael Jordan.
Your motor is...
But the shoe is just a shoe.
Until my son steps into it.
Oh, if you're not excited for that, something is wrong with you. You don't have a pulse. How about them apples, you might say? The film from Amazon Studios hits theaters April 5th. Affleck plays Nike founder Phil Knight. Matt Damon plays Sonny Vaccaro, as you saw there, the sports marketing legend who signed Michael Jordan. 20 years after his retirement, the Jordan brand still makes Nike nearly $3 billion a year. More than a quarter century after Good Will Hunting, 50-somethings, Ben Affleck and Matt Damon, still get it. What Hollywood seems to have largely forgotten: inspiring, uplifting, true storytelling like Jordan's shoes still sells. And just like Jordan's Bulls, this flick has a strong supporting cast. Best Actress Viola Davis, Jason Bateman, who's hysterical, Chris Tucker, they fill out the starting five. This movie just might be my favorite movie in 10 years. I think it's going to be in my top 3 of all time, and it doesn't come out until April. I just think these are the types of movies that we used to see with our sons and daughters, and they just don't make them anymore because they've got to be these massive superhero-type blockbuster hits. You're not feeling my goosebumps.
I am feeling your goosebumps. I'm going to say there's a lot riding on the line with your hype going into this movie. I just hope that it's able to deliver. I love the trailer, though. I am very, very excited for it. Clearly, it's going to be a home run. I think, like you're talking about, Affleck and Damon will largely come out winners on this, but it's also a huge home run for Amazon as well. And I think it could really reshape the streaming game in terms of how they release some of their big movies. We've seen some resistance from Apple, from Netflix in the past, but the pressure is going to be on them to follow suit, I think, because I do think you're right. I think this is going to be the movie that gets a lot of people back into theaters, people that haven't yet returned from the pandemic, and Amazon clearly is going to come out on top there too.
Yeah, Amazon deserves a lot of credit for courageous taking on stories like this that I think can really resonate with an audience. A colleague of mine said, "Why do you think Michael Jordan wasn't in that trailer?" And I said, that was a stroke of genius, because whoever plays Michael Jordan, and they haven't even told us that, it's not in any of the press releases, that would have been the only thing people concentrated on, because they would have said that wasn't like the real Michael Jordan. I don't think you'll hear him speak much in this film, because that can only disappoint people. Okay, I'll stop.
Are you going to be able to sleep the night before you go? Doesn't sound like it.
I will sleep outside the theater.
Yeah, I think you definitely will. I think you definitely will. All right, we're all clearly very hyped for this movie coming out in April, so we've got some time there. All right, well, coming up, we are counting down to the closing bell on Wall Street. Stick with us.
We are just minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down this market action. Been largely in the red, my friend. Still there?
Yes, and look at the Nasdaq, down 1% today. Over the last 2 days, down about 2.7%. So looking at a string of losses here, but trying to keep them at 2. Now, let's take a look inside the market. All the S&P 500 sectors in the red, XLC doing the worst. Guess what? That has Alphabet in it. And let's take a look at the Nasdaq right now. We know that's a function of the AI wars going on with Microsoft, but even Microsoft down 1%. Tesla's up 3%. AstraZeneca's up 4%, but seeing a lot more red than green here. And let's take a look at our leaders. Chinese stocks in the lead. We got emerging markets and chip stocks showing some life. But I got to get to the travel section. We had that big Southwest hearing today. You can see stocks down 1.22% intraday. On a year-to-date basis, it's only up about 3.5%. It's definitely underperforming its peers here. But we did learn from the COO that they're probably going to be scaling executive pay going forward. So here is a closing bell on Wall Street.
Stocks ending the day in the red. All three of the major averages closing to the downside. You're looking at the Dow off just about 250 points. Nasdaq off about 1%. Let's take a look at some of the top movers of the day. Our senior autos reporter, Prasad, remaining here with a look at Lucid because shares closing the day in the red. And let's take a look at where Lucid is closing. I believe they're closing in the red today as the company announces, quite a bit, as the company announces that it will provide electric vehicle discounts for 2 EV models that priced above the threshold for a government subsidy. Pras, when we talk about the strategy here, clearly they're trying to boost demand. Now, these are for vehicles that don't even come close to what that federal subsidy would be, right?
Yeah, I mean, they're giving you this. If you can't get the credit, they'll give it to you, right? $7,500, but funded by Lucid themselves for 2 models, the Lucid Touring and the Grand Touring, both starting over $100,000. So yeah, you're not going to get it for that usually, but hey, they'll give it to you now because they want to really boost sales, and they'll take the hit financially right now in order to just sort of get more people's more in their hands. But the thing ends end of March, which is an interesting date because that's when the new battery requirements come into place potentially by Treasury. And there's thought that once those new requirements are in place, no car will be able to get that tax credit. So they're just going to go with the flow until March 31st and then take that hit, sell more cars. And then when it goes away for everybody, they'll be fine.
I'm not sure on the top end. You're talking about the Touring and the Touring Grand, 107, 138. If you're spending that in a car, I'm not sure you care about $7,000. But I'm just curious about the stock falling almost 11% on this should be good news. We saw it really benefited Tesla. What do you make of the stock drop?
I mean, the problem is they don't make any money really on their cars so far. They're all negative. It's all negative margins.
Goodbye margins. They're already
whatever
gone.
you had are going to be hit by $7,500 each. I mean, that's like 8%, right? If not less. So it's not a good thing for them. But they're just willing to take the hit. They have money to run, money to burn for now at least, and just trying to get more cars into the hands of owners.
Well, Pross, another story that we're watching in the auto space is GM. They have a new chip-making partner. What is happening here, and how big of an improvement could this potentially be for GM's inventory?
You know, GM didn't suffer that badly last quarter with regards to chip prices, but now they're kind of taking their matters in their own hands here with the exclusive deal with Global Foundries. Chips made in the U.S. and upstate New York. They're calling it the capacity corridor for GM's chips. Huge for GM here because they're getting these chips that they say they might need a double amount for in a couple of years because they want to reduce the complexity, use simpler chips, more of them in their products, and it's also a big win for Joe Biden, right? President's Chips Act here. Also, Senator Schumer, he's a co-sponsor of the bill. He also talked about touting the Empire State region as an area for chip building. A couple of details that we're not hearing about the amount of money invested in the factory when they didn't say what that was going to be. We didn't hear about chip capacity, but we do know that Global Foundries invested something like $15 billion in that upstate plant in New York. So really bringing home a lot of that chip building here as opposed to building it elsewhere.
And Press, do you also think that this might be the start of something more when you talk about some of the competitors out there who have also had some supply issues? Maybe they will be turning to more manufacturers inside the U.S.?
Yeah, why isn't Ford doing this, right? And maybe they will do it soon because they have a ton of cars built in the U.S. coming online soon, 2024, 2025. So why wouldn't you line up a chip deal with one of these manufacturers and then use the U.S. incentives to build that factory here?
What has the analyst reaction been so far, just in terms of the fact that these automakers are still struggling with supply issues at this point, and we're almost 3 years since the start of the pandemic?
You know, it's funny. A lot of the analysts, it seems to me, the analyst chatter is that they take the automakers at their word that they will be able to supply these 100,000, 500,000, even a million vehicles by 2025. But you have to wonder, A, where are you going to get the materials for the batteries? And B, are there enough chips there? I think there are enough chips. I think it's more of a battery issue. So I think analysts are saying this is a good thing for GM. It's a good sign that they want to take it into their own hands, get their own chip supply direct from them, exclusive to them. So I think it's smart. I think you'll see more manufacturers do that potentially in the future.
All right, Bronze, good stuff. Appreciate that. Okay, AI isn't just a passing fad. It could be here to stay. That's according to a new note out from Morgan Stanley today. Yahoo Finance's Dan Howley joins us now on this conversation. Dan, what's in the note? What's the key takeaway here?
So there's a few things. The main thing is that it looks like this kind of AI that we're seeing is going to be around for quite some time. The big headlines that we've talked about, the Microsoft Bing, the Google Bard, those types of technologies seem to be as though we'll see them for quite some time now. I've been actually using Bing. I'm going to have a piece coming out tomorrow about what it's like, but it's been pretty interesting so far. According to this note, though, there are a few downsides to this kind of technology, and that is that according to their tech, telecom, and media, or tech, media, and telecom team, the cost per query is 7 times higher when you're using these kinds of AI technologies versus a standard algorithmically driven search engine. And that's just because it's going to generate, their generative AIs, an answer for you, and they have to pull out from a ton of different sources. And so that could be a problem for upstarts, but not these big incumbent companies. They also point to the fact that it looks as though some venture capital companies, or venture capital firms, are moving away from funding the smaller upstarts just because we have these huge firms like Microsoft, like Google, pushing into them, but they are conversely going into the safety area and the moderation area, where you provide safety, provide moderation for these platforms, so you don't end up with some absolutely wild stuff getting through that they say is true. For the casual observer here, Dan, people have said metaverse is going to change the world, right? And then it was Bitcoin and crypto and blockchain is going to change the world, and then it came all these collapses. So those people are feeling a little bit burned. Why is this different inherently? So, okay, so there's two things. This it feels as though it's going to be a add-on feature. It is not the end-all be-all of search, right? It's something Microsoft purposely puts it on the right side of the screen in Bing. There's also this idea of the trough of disillusionment, where you go into this kind of new type of technology, and everything is about the projections of what it's eventually going to do. And they're all outrageous, through the roof, but it takes time to get to those points. That's the idea. The metaverse, VR, things like that. Everybody's like, well, we're going to be walking around in like VR bodysuits and, you know, floating in like a virtual Mars or something. The reality is that takes forever. So you go into this trough of disillusionment where everybody kind of just sours on the technology, and eventually we start to see some kind of gains and get to the point where, you know, those projections were. This, though, isn't necessarily dealing with that same problem. Those other technologies for sure are. Google got hammered yesterday on this seemingly minor mistake that was actually a part of a pre-produced ad, which is shocking for a company that spends that much on advertising. But it's getting hammered again. Is it much ado about nothing, or is that a big problem for Bard as they roll this thing out? I think they really screwed up on the advertising there. That was a big message. Basically what they said was, you know, people were pointing out that the way the sentence was framed was that it seemed inaccurate. It wasn't that it was the first photo taken of an exoplanet. It was of a particular. So it was the syntax of the sentence, right? It's not that it was wrong. It's just that it was framed in a way that you can interpret it wrong. I just think that Bing right now has the momentum. Bard doesn't seem like it's going to be doing much that's too different. Bing is really going completely different direction, and it's really interesting.
All right, great stuff there, Hal. I want to jump in here because we have Lyft's results that are just coming in right now. The stock taking a huge hit after hours, off nearly 20%. That has to do with Q1 revenue guidance, which missed the street's expectations. For the fourth quarter, though, revenue coming in at $1.18 billion. That's up about 21%, topping the street's estimate. Adjusted net loss, though, $270.8 million. When we're looking at the number of riders, fourth quarter active riders coming in at 20.36 million, essentially in line with the street's expectations. Revenue per active rider just above $57, $57.72. But that weak guidance, that light guidance that we're getting for the current quarter right now is a big reason why we're seeing shares sell off in extended trading. Well, coming up, we will take a deeper dive into Lyft's fourth quarter results. We'll be right back. Taking a look at shares of Lyft, they're now off just about 22% following the company's fourth quarter results. The company's first quarter revenue guidance coming in a bit light. That's a big reason why we're seeing shares fall here in extended trading. Revenue, though, for the fourth quarter up about 21%, 1.18 billion. Estimate on the street was for 1.16 billion. So just beating the street's estimates there. Prost Supermanian back on set here to take a deeper dive into this report. And Prost, just looking at the share reaction in extended trading, clearly lots of concerns about that guidance number.
I mean, there was concern that Lyft wouldn't match Uber's results, and they didn't. You note that revenue guidance light, $975 million versus $1.09 billion expected. There was talk that management was very conservative about their guidance, and they still missed the guidance, right? So missed it by a lot. So I think this is really hitting the stock. You know, looking at revenue up 21%, that's fine. Active riders in line with estimates. The loss, 74 cents loss compared to a small little adjusted expected gain. In contrast with Uber, right? Like revenue up almost 50% compared to a year ago. They expect operating income profitability this year at some point. So the businesses are just sort of, they're sort of similar, but they're being operated in a much different way. And Lyft focusing on the U.S., of course, they don't have the ancillary businesses like deliveries, like freight, like even rental cars, right? So I think this is the big issue for Lyft right now. And I think the call will be important is what are they going to do to are they going to see any kind of profitability coming in the second half of this year? How are they going to boost revenues? How are they going to expand the business? Are they going to get into other types of ancillary type logistics type of activities that Uber's done, or as someone once said to me, like, are they going to get bought by somebody and this be some other ancillary service for another company? So
you can't help but wonder if they're an acquisition target. Okay, it's not great. That stock fall does not represent the numbers I'm seeing here. Does it fit what you're seeing? That seems like a massive investor overreaction. We knew what Lyft was. We knew they were a largely US-based company. We knew they didn't have the delivery, the eats. Is this the reaction you would expect from the report you just saw?
It just, I think again, it's a guidance, a revenue miss for Q1, and the fact that it was already conservative. Like analysts wanted just barely a little bit more than Q4, and they had less than Q4, right? They're not building they're not sequentially building revenue quarter to quarter. So I think the question is, are they able to sort of grow that and also keep profitability per user? I think that's what's kind of discouraging right now. I think that's why we're seeing, extended trading is light trading, but clearly the intention here is to sell the stock now. So I think that's what we're seeing in the aftermarket.
A flee from that stock right now, Parsed Subramanian, as shares just continue to plummet. Joining us now to break down Lyft's earnings, Roth MKM's Managing Director, Rohit Kulkarni. Nice to see you, sir. So what do you see in this earnings report? Are you surprised at all by that type of investor reaction?
Hey, thanks for having me. I think the reaction is based on what happened prior to the earnings result. People tend to forget that the stock was up 60, maybe 65% since December lows. Again, was there a specific reason why the stock was up? The market is up, Nasdaq is outperforming, and then all the tech companies are going up 30, 40, 50%. So Lyft was up as part of that wave. So what they needed to do was expectations had been grinding higher, and they needed to just jump over those higher expectations. In isolation, 4Q numbers are not that bad. They are actually better than what we had expected. 1Q guidance is much more worse than what we had expected. But again, whether this reaction is in line with this weakening of fundamentals, I don't think so. It is just mostly based on what happened prior to. The stock was up 65%. I'm not surprised that it is going to give up some of those gains. The company is making progress towards profitability, but again, it is just slow progress, and it is much, much slower than what Uber is showing us.
So in regards to the reaction here, because revenue guidance, it was light. It might have been better than what you were expecting, but in terms of street consensus, we're expecting to see Q1 revenue of $975 million. The estimate out there was for about $1.1 billion. So $975 million, that of course would be a step down from what we saw last quarter. How does that set us up then into this new year? Clearly investors are a bit skeptical about Lyft, its ability to compete with Uber. What's going to change investor sentiment on Lyft?
It's going to take some time. And I think this provides greater evidence that perhaps some of the market share gains that Lyft had managed to do prior to the pandemic, during the pandemic versus Uber, all those market share gains are reversing back and at a very, very rapid clip. Also, another kind of benefit of doubt that some bulls to Lyft may give is that Lyft is over-indexed to West Coast as compared to Uber is kind of more over-indexed to the East Coast. And if you look at reopening back to return to office trends in West Coast versus East Coast, clearly West Coast is lagging, and that is hurting Lyft, and that is probably leading to more market share loss. I can't help but wonder what will change this loss of market share in the near term. They are still a single product, single geography company. They need to hold on to the market share, and that's not happening right now.
Logan Green, co-founder and CEO of Lyft, says the better marketplace balance we see today creates significant opportunities for long-term profitable growth. As part of the release, some have mentioned Lyft as a potential acquisition target down the road. Do you foresee a time that could happen?
It is possible. Never kind of discount a potential acquisition target for a company like Lyft that has a good brand name, that has built out a network, that has a following amongst specific geographies. But again, I think for them to become a more viable acquisition target, there needs to be a clear pathway to be masters of their own destiny as far as cash flow and profitability is concerned. I think they are a few quarters away from that. If they go into a slow growth but a very slow cash burn mode, I think, the likelihood of them being acquired is something that is possible. We published about that earlier in January. We talk about black swan events. I think Lyft is one of that kind of M&A candidates that could be bought out. But again, they need to show cash flow generation capabilities in the network right now, and we are not close to that.
Who could be one of those potential companies that could look at this acquisition? The market cap currently just shy of $6 billion.
It's hard to contemplate right now, but again, from a value proposition and travel perspective, there are online travel marketplaces that wouldn't mind having that extra leg to adding one more layer onto the spend that travelers want to do. So there are elements of given Lyft's exclusive focus is on travel, is on mobility. I feel any travel company, be it online or offline, may want to have that extra leg to the stool from a consumer engagement standpoint, from a consumer touch point standpoint. So that feels more logical. But again, as I said, it is not something that may happen in the next month or so. It feels like the company needs to clear out their fundamentals, have a more kind of sustained execution for that to even come to the table.
Rohit, what about the regulatory environment right now? Uncertainty in California, uncertainty in New York. How big of a potential headwind is this for Lyft?
Again, I think that's a more of an industry headwind that affects all the players in the industry. It drives a negative sentiment where long-term sticky investors still are worried about what happens to these companies if 1, 2, 3, 4 years from now there is a significant negative event from how drivers are being treated as independent contractors or employees, or whether there are extra supply and demand constraints that some metro areas put on these companies. So I think Lyft is not alone in that battle. Uber, Instacart, DoorDash, all those companies tend to have similar exposure. Having said that, being the smallest player in the town, they tend to get an asymmetrically higher negative sentiment given everybody bears the burden equally.
Not seeing anything about massive cost cuts. They did lay off 13% of their staff back in November, about 700. Do you think we're through that, or could we hear more?
I wouldn't be surprised if today's stock reaction, their guide for pretty shallow EBITDA profits in first quarter kind of forced the management back to the drawing table in terms of what the steady state cost structure needs to be and what are the priorities when they want to balance growth versus profitability. I feel that's what made that conversation may have already been triggered. So I wouldn't be surprised if there is another round of cost cuts. May not be only headcount driven. They could just shut down some new ambitious projects. They could shut down some real estate projects and so on and so forth. So I think a lot of costs are variable for such companies, and I feel Lyft can still take out some costs from their operating model.
All right, Rohit Kulkarni, thanks so much for joining us again. Lyft stock off over 20% here in extended trading. I want to also turn to PayPal. Those earnings results are out. The stock popping just about 5.5%. Lots to unpack here in terms of a headline. One being that President and CEO Dan Schulman, he announces his plans to retire from PayPal at the end of the year. That was a separate announcement from the earnings released at the same time. But over to the earnings report, adjusted EPS coming in better than expected, $1.24. The estimate out there was for $1.20. Payment volume, though, total payment volume did miss the street's expectations, $357.38 billion. That was lighter than what the street was looking for. Also, revenue, a slight miss there, $7.38 billion. The estimate was for $7.39 billion. Their guidance, though, coming in better than expected. Full year adjusted EPS forecast of $4.87 was more than what the street had been expecting. So that's a big reason why we're seeing shares pop here in after hours trading, up just about 5.5%. But again, CEO Dan Schulman is planning to retire from the company at the end of the year, and PayPal is retaining a search firm to find a successor to Schulman. All right, well, coming up, a deeper dive into PayPal's latest financial results. Don't go anywhere. Let's take a look at PayPal. Shares up just about 2.5% here following their fourth quarter results. Adjusted EPS coming in better than expected. Revenue a bit light there, but in terms of their guidance, their full year guidance for 2023, coming in better than expected for adjusted EPS of $4.87. Let's talk about all this when it comes to PayPal's earnings with Moshe Katri of Wedbush Securities. He covers the IT services and payment space there. Moshe, it's great to have you here. So let's start with the big headline. One of the big headlines of this afternoon, President and CEO Dan Schulman planning to leave PayPal at the end of the year. What's your reaction to that? He's been there for 8.5 years.
Yeah, I would say wildly expected. In general, you've seen a leadership vacuum at PayPal during the past few years. This is a company that's been running without really having a permanent CFO. And there's been an expectation that maybe with the encouragement of the active investor here, you'll see a leadership change at the CEO level as well. So this is definitely within expectations.
And what do you make of the numbers?
You know, better than feared, more than anything else. The sentiment getting into the quarter was actually relatively negative. You know, anywhere from competitive concerns, is Apple Pay taking share, discretionary spending moderating, which is something that we've heard from the networks and from some of the other fintech players. They obviously beat on earnings, just given the fact that they've been focusing more on cost efficiencies. Some of the numbers on the metric on the top line side were a bit lighter. You know, revenue's a bit lighter, TPV volume is a bit lighter. But look, this is a company that's trading at very attractive multiples. You know, they're doing a good job, I think, relatively on the monetization side of the business, and they can do a lot more. And, you know, I'm assuming in this market, it kind of makes sense for people to kind of own it, especially given the active investor involvement here.
Yeah, given that active investor involvement from Elliott Investment Management, we certainly have seen some improvement in terms of margins, some cost-cutting initiatives from PayPal. Do you think there's more room for cuts going forward?
I think there is more room to cut for cuts, specifically in terms of technology budgets. I'm assuming a lot of the work is getting done still on site. These days, you can probably shift towards a global delivery model, so you can probably save there. And then on top of that, you can probably get scale from better monetization of the merchant side of the business and also from the user base. So yeah, from our perspective, you can probably extract some more cost efficiencies in the model. But again, for the stock to really work in the long term, you have to see better growth rates. And better growth rates is really a function of monetization efforts on both sides of the platforms.
Recently cut 2,000 jobs, about 7%. You mentioned Apple Pay. How significant is Apple Pay? Is Google Pay cutting into their market share?
There's been some concerns, given some of the data that came out a couple of months ago, that Apple Pay is taking some share on the user side and also on the branded checkout part of the business. We need to see some more data to actually substantiate that kind of assumption, but you know, you could actually see that Apple Pay's numbers continue to look very, very strong in terms of volume growth. And then on the flip side of it, PayPal's volume growth has been relatively stagnant. But we need to probably see another quarter or two of data to kind of get that trend kind of substantiated.
You say we need better growth rates. Is it possible for PayPal, for a company like them, to do that in this current economic environment when so many consumers are pulling back on spending?
Yeah, so let's think about this. You have roughly 450 million users on the consumer side of the business. And at this point, it's an ecosystem of kind of digital banking, if you think. And if you think about this, and it's about your ability to cross-sell some of those digital banking products into that user base. So that's on one part of the platform. On the second one, you have north of 30 million merchants that you're catering to. And again, it's an ecosystem of products and services that you're kind of selling into. And if you're able to kind of, under the right leadership, to do a better job on monetizing these products into those users, both on the consumer side and merchant side of the business, you can probably grow revenues irrespective of what's going on with consumer spending.
This is a company that's trading basically at, as I look at 2018 levels. It was a $308 stock, $360 billion market cap, now trimmed to around 90. Is this a company that's dying, that's growing, that's maturing? How would you describe your sense of where it's headed?
Yeah, so let's look at PayPal maybe 2-3 years ago, pre-pandemic. This is when e-commerce growth was roughly about 10%. During the pandemic, e-commerce growth went to 25%. And this is probably when you got to that $300 level. And then during the past year and a half, you've been kind of normalizing growth back to pre-pandemic levels in e-com to roughly that 9-10% level. So that kind of explains that kind of run trip that you're talking about. And this is why monetization is going to be so important in order for these guys to kind of show better growth rates down the road. So it's more of a round trip in terms of what happened pre-pandemic, during the pandemic, and then post-pandemic to e-commerce growth.
Very well said, Moshe Katri from Wedbush. Good to see you, sir. Thank you. Coming up, Jay Timmons, the CEO of the National Association of Manufacturers, is here to tell us how manufacturers are coping with high interest rates and a slowing economy. Stay with us.
President Biden touting a manufacturing and a State of the Union address earlier this week, focusing on the future job creation in the semiconductor industry as a result of the recently passed CHIPS Act.
We're going to make sure the supply chain for America begins in America. The supply chain begins in America. We've already created 800,000 new manufacturing jobs without this law, before the law kicks in. With this new law, we're going to create hundreds of thousands of new jobs across the country.
All right, for more on reaction to that, I want to bring in Jay Timmons, National Association of Manufacturers CEO. Jay, it's great to see you again. So we heard President Biden taking credit for all the jobs that have been created within your sector. Just first, your reaction to what we heard from President Biden this week.
Well, look, I think President Biden ought to be pretty proud of the fact that there's been more manufacturing jobs created in the last 2 years than in any other 2 years period since the first term of Ronald Reagan. And he also rightfully and proudly pointed to part of the reason for that was the successful bipartisan legislation to invest in infrastructure that he got across the line, as well as the CHIPS and Science Act, which you led with. I think the problem, Shauna, is he did miss the mark in a couple of areas. And that is by not acknowledging the fact that there was a lot of foundation that was put in place to allow that success to occur. So think of trade agreements during the Bush and the Obama administrations, and then the tax reforms and the regulatory certainty of the last administration. All of that, plus infrastructure and chips and science, has enabled manufacturing to grow at record levels.
Well, Jay, when you take that into account, the fact that he is calling for higher taxes now, I know there's also a crackdown here just in terms of restrictions on pharmaceutical innovation. What would that then potentially do to your sector?
Yeah, so isn't that the irony? So yes, he can celebrate 2 years of great growth, but he can harm that growth if he's successful in other areas. The areas where he's been successful, that's really added to the growth in manufacturing jobs. But if he was successful in terms of raising taxes and getting some of the revenue proposals that he's been pushing through, that could be problematic, as well as some additional harm that could occur with pharmaceutical manufacturers or the energy producers, for instance. We're going to be. I know J.J. Watt is following this particular segment, and I could probably use some advice from him on defense, because we're going to be needing to defend ourselves against some of these proposals.
I know. Well, we wish that you guys could all join together here. We'll have to ask him about that, or maybe you guys can hit each other up on Twitter. But Jay, when it comes to what you're seeing right now in the sector, President Biden saying that he plans to create even more jobs, and as it stands right now, you can't even fill the jobs that you have opened. How does this set us up here for the next 5 years?
Look, I think we're set up for success as we currently are situated, right? As long as the regulatory environment is held in check, and it's not right now. We have a lot of problems with what's coming out of SEC and EPA, for instance. But look, the CHIPS and Science Act, the president is exactly right. He put a lot on the line to get that across the finish line. And rightly so. We were having some very significant problems in terms of the chip supply chain, which we saw in terms of the inability to even access or to purchase cars or other things that have chips in them, which basically is everything that's produced these days. So this is a really good start to ensuring that American supply chain, especially when it comes to chips, is intact. That will create more jobs, and that will create more opportunities. To your point, we have 840,000 on average every month open jobs in the sector, and we're doing everything we can to recruit new entrants into manufacturing. We think that as the pandemic relief kind of winds its way out, that $4 trillion that the last administration pumped into the economy, which effectively served as a reason for a lot of people not to work, as that winds its way out of the economy, we think that we'll be able to attract more folks into the sector, and we also hope for some immigration reform to help us in that line, in that way as well.
Yeah, I know you've talked about the challenges right now just in terms of the current immigration policies. Jay, when it comes to attracting more of those workers into manufacturing, is pay at all an issue?
It is an issue, and it's an issue that actually inures to our benefit, because manufacturers pay more than any other sector of the economy. The average position all in is about $95,000 annually. So it's great. It's a great pay. It's a great opportunity. And the best part about manufacturing, especially modern manufacturing, manufacturing of today, is that young people who are inspired to do great things to change the world for the better, whether it's in terms of climate change or solving that next big disease problem that we may have. All of that is achieved because of manufacturing. And so more and more young people are looking at manufacturing as a career. About a third of the jobs in manufacturing don't require anything more than a high school degree. Others require, college and advanced degrees. So there's really something for everybody in manufacturing. And we're hopeful that we're getting that message out.
Jay, when it comes to lost business because of the inability to hire here, is there a way to quantify that just in terms of the scale or maybe what businesses have lost out on over the last couple of years because they couldn't hire at the rate that they wanted to?
Yeah, I don't think I can quantify the last few years, but what I can do is quantify the next several. So by the year 2030, if we don't change our trajectory, there's going to be 2.1 million jobs in manufacturing that are not filled. That will equate to about $1 trillion a year in lost opportunity costs, if you will. So it is a big drain on the economy if we can't get those workers into this sector. The sector, of course, being so critical to economic growth across the entire economy.
All right, Jay Timmons, always great to have you. Thanks so much for joining us again here at Yahoo Finance.
Great to see you.
All right, well, coming up, 3-time NFL Defensive Player of the Year, J.J. Watt, joining Yahoo Finance Live. We will break down the quarterback matchup on Sunday and fill us in on his latest moves with Gatorade. Don't go anywhere.
All right, Super Bowl 57 just a couple of days away and featuring two of the most dynamic quarterbacks in the game today, the Eagles' Jalen Hurts and the Chiefs' Patrick Mahomes. Ahead of the big game, though, one of the biggest draws in Arizona where the game will be played is the now retired 3-time Defensive Player of the Year, future Hall of Famer J.J. Watt in his backyard where he spent the last 2 seasons of his storied career. He joins us now. Always great to see you, J.J. Appreciate you giving us the time. So you faced Jalen Hurts earlier this year. You faced Mahomes a couple of times. What makes these guys so difficult to contain, and who do you think has the personnel to do it?
I got to be honest with you. I thought I was coming on to talk semiconductors, inflation, and the debt ceiling.
Please do.
This is going to be a tough pivot for me here, but let's see here. It's going to be a great game. It's going to be a hell of a game. I'm a line guy, obviously being a D lineman, so I'm very, very much looking forward to watching the offensive and defensive lines. The Eagles' defensive line is one of the best I've ever seen assembled. They got guys like Robert Quinn and Ndamukong Suh coming off the bench. That tells you how good they are. The Chiefs have Chris Jones. They got Frank Clark. And then that Eagles offensive line is incredible. So when you got Patrick Mahomes and Jalen Hurts going at it, you don't need to give those guys any more shine. They're unbelievable in their own right. So for a guy like me, I'll be watching the battle in the trenches.
You must have an inkling. Who has the better personnel here? Who has the edge?
I mean, when I look at what I just talked about, I think with the Eagles offensive line and defensive line, I do think they have a slight edge in that category. So I think that they're very, very strong. They're very well built. They all work together extremely well. But then at the exact same time, you look at the Chiefs and you got Patrick Mahomes and Travis Kelce. I'm not an idiot. I'll never count those two out of anything.
You mentioned Travis Kelce. That's one of the other really special storylines here. Jason Kelce, Travis Kelce, first ever brothers Super Bowl meeting. And you can really relate here, having two brothers who play in the NFL for the Steelers. How different are the Watt brothers than the crazy Kelce brothers? And if you get a 2-on-2 WrestleMania, who wins?
Well, there's three of us, so we win. That's the easy answer.
That's why I said 2-on-2, though, JJ.
No, they're great. They're unbelievable. Obviously, their parents have an incredible week ahead of them. Weekend. It's going to be a blast. It's special just to play with your brothers in this league and to be able to share those experiences, have those conversations. I mean, we get to talk about our jobs at the highest level in the NFL. And these guys are doing it now on Super Bowl Sunday. So I know it's going to be a very special day for their family, and rightfully so. I hope they take it all in.
I'm sure they will. You recently announced your retirement, saying you want to spend more time with your family, most importantly, that newborn son. I'm a father, I can relate there. So I mentioned the accolades. You're a 3-time Defensive Player of the Year. You're a 5-time All-Pro, Walter Payton Man of the Year. What do you want your son, Koa, to know about his dad, the football player?
I want him to know about me as a football player, that I played the game with passion, that I attacked it. I tried to do my absolute best every single time to help my team win games. And I gave it everything I had, because that's how I want him to attack life. I want him to attack life with passion. Whatever he chooses to do, I want him to go all in on that and give it everything he's got and be the best man he can be. And I also want him to not only be remembered his dad for playing a game, but for trying to help do things that change the world off the field as well. But most importantly, I just hope he remembers me being a good dad. That's part of the reason I am where I am today, is because I want to spend more time with him and make sure that I am the best dad I can be for Koa.
I'm sure you will crush that. You have more time now to work on that golf game that, with all due respect, like mine, could use a little work. More time to work with brands like Gatorade, who is now in the energy drink business with the Fast Twitch. It's a crowded shelf, the energy game. What makes Twitch different? We've seen you, I believe, drinking it on the sidelines this year. I got a long night ahead, so I'm going to go ahead and give it a shot.
Oh, you go ahead and you give that a shot. Your night's going to get even longer, but it's going to get even better. Because Fast Twitch gives you all the energy you need. It's you're going to be amped up. It's just what you need before a game, before a workout, or before a night out. I'm not going to tell you how to live your life. Go enjoy it. But it gives you that energy. It gives you that boost. It gives you that little kick, that caffeine, and it's delicious at the same time. So if you're going to have yourself a night, grab a bottle of Fast Twitch on the way out the door.
I hope it doesn't keep me up all night. It's pretty delicious.
Oh, it will. No, it absolutely will. That's its job. So put it down now if you're not looking to be up all night. You got to drink it. You just got to. The rest of the show is going to be unbelievable if you drink it.
It's going to be awesome, man. You don't know me, JJ. I need to actually wind it down a little bit, kind of like you. So other business endeavors you're involved with, I'm just curious, what are you most interested to use this time on? You could be in the broadcast booth. The world is your oyster. You could do anything. You could own a team. What are you most excited to do beyond spending that time with the family?
Yeah, I mean, there's obviously, I'm right now at an opportunity where there's so many avenues ahead of me, and I'm very much enjoying exploring them. Team ownership is something that excites me, especially soccer. I'm a huge soccer fan. My wife, obviously, a professional soccer player. EPL, Premier League is fascinating to me. So I think that there's certainly an avenue there. I do enjoy investing. I'm very deep into that game, and I enjoy it very much. I have a percentage of a kickstand cocktail business that just opened up down here in Arizona, which is great, and many other investments. Also broadcasting. I mean, I love the game. I have a lot of experience and knowledge that I feel I can bring to the fans and give them an even better experience while they're watching the games. And then beyond that, I don't know. But the beauty of it is right now, I just get to sit back, enjoy it all, and explore these avenues as they come. And who knows what happens next, but that's the beauty of it.
It'll be fun to watch you go into the hall with the GOAT, Tom Brady. You tweeted him, congratulations upon his retirement. You added at the end there, the newly retired group meets on the golf course every Monday morning at 10. So I'm curious, it's you and Brady. Who else is in your dream foursome, JJ?
Oh, my dream foursome of all time. I mean, Tiger's got to be in there. You got to play with Tiger just to be in it. And then I feel like you got to throw John Daly in just for the experience. I mean, just for somebody to give us that entertainment value, you know?
Smoking some cigarettes and 19 Diet Cokes. And, well, I can't wait to see John Daly drink a couple of these fast twitches.
And John Daly, who knows what happens.
I'm going to finish mine. It's great to have you on. JJ Watt, congratulations on your retirement. Best of luck in whatever you do. We know you will crush it. Good to have you, my friend.
Thank you, guys. Have a great day.
All right, and a quick programming note here. Be sure to watch our big game coverage Friday, February 10th from 4 to 5 Eastern Time. We'll dive into everything from sports betting to ad spending, even get into some prop bets like what color Gatorade they're going to dump on the head coach. And you know, I should ask JJ. Coming up, those shares of Expedia tumbling after hours. We'll tell you why next.
All right, 3 stocks that we're watching here in After Hours. We've got Lyft, Expedia, and PayPal. Let's kick it off with Lyft because we're looking at losses of nearly 25% in extended trading. The company's Q1 revenue guidance coming in a bit light. Fourth quarter, though, the numbers were pretty decent. Revenue up just about 21%, $1.18 billion. That was better than what the street was looking for. Active riders, about 20.36 million, up 8.7%. But year to date, we're already looking at gains of nearly 50% in the stock, so a slight disappointment. could mean a huge move to the downside. That's clearly what we are seeing here in after hours. Moving over to PayPal, that stock up just about 1% here, up about 1.3% in extended trading. The company beating the street's expectations when it comes to EPS. Also, their full year earnings guidance, adjusted EPS guidance, was also better than expected. CEO Dan Schulman, he is planning to retire from the company at the end of the year. We just heard from an analyst that maybe that was a result of Elliott Management's involvement with PayPal. Year to date, you're looking at a pop of just about 10% over the past year. Certainly a different story with the stock off about 36%. And moving on to Expedia, that stock off slightly here in extended trading, off just about 0.25%. Revenue and EPS missing the street's expectations. Fourth quarter gross bookings also coming in a bit light at $20.15 billion. Now, why did they miss? The company actually is blaming it on weather, and they're saying that disruption is not going to be an issue going forward. Maybe that's why we're not seeing more of a reaction in the stock after hours. Over the past year, though, certainly has been a tough go at it for this company with shares off just about 40%. Dave?
Okay, Shauna, thank you, my friend. My stock to watch for tomorrow is Newell Brands. That's the company behind Rubbermaid, Yankee Candle, and Sharpie Markers, a Trump favorite. Newell reports its fourth quarter earnings before the bell Friday morning. Analysts are expecting earnings of 11 cents per share on revenue of $2.2 billion. We'll be looking to see what management says about the strength of the consumer and get an update on cost-cutting measures. Last month, Newell announced it was cutting 13% of its office staff. That will do it for us today on Yahoo Finance Live. Be sure to join us tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell. See you tomorrow.